Indiacharts, the truth about the markets.
Indiacharts publishes Nifty daily video updates, the weekly Elliott Wave outlook, and the long-short report covering all asset classes.
Good evening, everyone. This is the 20th of January 2022. We are into the third week of this month, pre-expiration week. Next week is the monthly expiry, and then following that, the next week is going to be the union budget. So what we've seen over the last couple of days is what I've been calling, even in my media interviews, if you have seen them, a routine correction. And the reason I've called it a routine correction is that it feels like any other correction that we've seen for 2-3 days, sometimes a larger knee-jerk reaction and sometimes a smaller knee-jerk reaction. What has been hard to always call is the size of a knee-jerk reaction. It can be 100, 200 points. This one ended up being more than 500 points, right? So from almost 18,300 all the way down to 17,650 is like maybe almost 700 points. So that's pretty big in terms of the high to low impact. Overall, it's a 38% retracement of the entire 2000 point rally we saw from 16,400, right? So in that sense, it's a normal 38% retracement. Now I call something normal depending on the size. So in this case, the size is from the 20th of December, the rally all the way up and then a retracement. If we similarly look at the previous rally, which started in April, went all the way into October. So that was a 6-month rally. And then we saw 50% retracement of that between October and November. So I even called that routine, but of course at a much larger degree. So it's a matter of degree. But the thing is, every time the market starts a sell-off, whether at a larger degree or smaller degree, somebody's got to come out and defend that this is a routine correction. And that's ended up being me for a long period of time, because I find fears really very, very high. Not all the fears are without reason. I'm sure there are enough reasons, and the media makes sure that you find enough reasons. But not all of them may be sound, So just running away because there's been a routine correction. I mean, this started even in the April-May period, right? So last year, when we started to correct in the month of March and then into April, it looked something like that. It was like a multi-week consolidation. But at the time it was happening, the fears of a larger correction, wave 1 is over, you'll get a big sell-off, 50-60% retracement, all those discussions went on. And I think once I couldn't see a 5-wave decline in the initial sell-off, I sort of backed off from those possibilities, So that sort of helped me stay away from that. And what I've repeated, I think, over and over again is the level of rotation we've seen in this market, sector-wise, stock-wise, has sort of, ended up meaning that different sectors are performing at different points of time. And that has kept the overall market to help it maintain its momentum. Having said that, I've also mentioned for those of you who attended yesterday's webinar, which was hosted by Traders Gurukul, Money Control in conjunction, and Espresso, which is the Sher Khan retail discount broking concern. I was speaking there, explaining a much more complex topic, more longer term in nature. At the end, I found that, given 2 hours, I had compressed something into 1 hour and 15 minutes, which may have gone above some people's head. But I broadly wanted to get one point across, that if you study the long-term macro cycles of the economy that occur over a 50 to 100 year time horizon, then I'm able to sort of point that we might have passed the point of a deflationary event into an inflationary period. And sort of what that really means is that whatever started in March of 2020 is a new bull market, and that bull market might not be over. Yes, at some point of time you can get that deeper correction. I haven't anticipated one yet. But yes, after the current rally, which is still ongoing, not over, maybe I'll try to consider it for the first time. I tried, for example, like I said, I tried it in March of last year. We didn't get an impulsive decline. I backed off. In October and November, I wasn't on top of it because I was sick for a while. But even then, when I came back, I didn't think it was a big sell-off. And many stocks and sectors have only ended up consolidating during that 2-month correction that we saw in November and December. And that's what gives me this sense of confidence that whatever is starting now is of a slightly larger nature, or at least it's a new rally that will last for a while before we give up again. And then that give up, will it be again similar to these recent 6-week corrections that we've seen, another one of the same type, and then again move up, and then another same type? Or is it going to end and then we go into a deeper 1 year long pullback? I think the rotation factor tells you that, it can go on with ups and downs, higher highs, higher lows, and, corrections along the way from a sector specific point of view. But if we remove that and look at the structure, yes, every time it will look like 5 waves up done, we are going to get that feeling that, maybe we should look for a correction. So we'll do a bit of both and try to only identify places where a correction is possible. And sometimes we even proven wrong on that, because while I did think the auto sector would, take off in October, and then it looked like, okay, maybe it can go into a consolidation, because it had already been through a 6-month consolidation in the prior period, all the way from early 2021 till I think September, and then it was breaking out of that. So it should have been the start of a new move. And then again, it didn't make it just made a new high and then gave up. And that sort of, gets us to question whether the move was for real. I've already published the auto index chart, I think few days back on social media, and we've switched back to the original idea that it could be a new move from the September lows and into October. So we'll stick with that as long as it works. So this is how you're going to have to do it. There are in fact sectors that did not fall at all. And in fact, even in the last 3-day correction, while it may have felt painful, and I've already got people calling me and talking about it going back to 16,400, something I'm trying to defend. The fact is that the fall, at least in terms of wave structure, which is the model that we follow, the decline into today's low is still corrective. It was the same yesterday. Intraday, at some point, it may have looked like 5 waves, but with all the zigzag movements, by the end of the day, it's again looking like a corrective retracement. And so far, like I said, 38% retracement of the entire rise. While that was happening in the last 2 days, we've actually seen strength in some sectors, especially in the cash market. A lot of the energy and power stocks were actually up yesterday and continued to hold on to those gains today. The same we've seen in PSU stocks. We've seen it in the metal index, one which I've been bullish on, mostly because I've ended up looking at the underlying commodities that are holding strong irrespective of the fears around the dollar and bond yields. So bond yields keep putting pressure on the dollar on the upside. I've had a long debate on that. I don't know when exactly the dollar will roll over and confirm my view, but I do think that all the upward moves in the dollar have been counter trend. So that have really not changed. And once we get that confirmation, it will probably give more confidence to the rest of the street, because the way I'm looking at it is not looking at the dollar first, but looking at everything else. And if I look at everything else and everything else is not giving up, then we end up continuing to hold a strong view on the dollar being the one that's wrong and not everything else. So that's an approach I've been trying to push, even through my nonsensical Hindi jibes, hoping to get that point across, because there's too much nonsense out there which is not really paying attention to what the market is trying to tell you, but simply to narratives that are floating around or being talked about in the media, because that's what is the hot topic of the day. So coming back to the main point, if we are really looking at either the metal index, where the weekly momentum last week had crossed over, to the buy side, that's the Rohit's momentum indicator, now available on Sharekhan Trade Tiger. If you're a user of that, you probably have access to it already. And on a weekly chart, we did get the buy crossover on the BSE metal index or the NSE metal index. And even if we look at commodity prices, we have a new high now in nickel. We have zinc almost having retraced a significant part of the decline it had seen in the last 2 months. You have aluminium prices having retraced 80% of that loss. And copper is the only one that may appear to lag a bit, because that's where that was the hottest commodity, I think, at the start of the entire commodity move. And all of that we cannot really ignore, that agro commodities have held out pretty well. We have a breakout in things like wheat, sugar in the last couple of days, and coffee, and even soya bean almost close to the breakout point. Soya oil, that is, and soybean prices have been going up. So most of these agro commodities also have started their next leg higher, all of which simply confirms with my larger thesis that we are in a commodity cycle that's much larger in nature, backed by the weak dollar. And commodity cycles don't just end. We've had a year and a half, 2 years of this, and you just can't end it because you've had 2 years of this. They can last for 5 to 10 years, and so you can have corrections in between. And the important thing to see is the best time to get a correction is when the dollar goes up. And after a 50% retracement in the dollar index during 2021, the correction we've really seen in the metals and agro space is very, very meager, except maybe in one or two which got a deep cut. Most of them have simply gone sideways and seen some kind of a broad consolidation range, not a deep retracement or a trend reversal. And so that is where the confidence comes in that at some point of time the whole thing is going to reverse and you're going to see the resumption of the upward trend. And there are already many early signs of that happening. So I'm going to be I've been promising, I think since last week, I'm going to be writing my long short report part 2. I already started but didn't conclude it. I think all the volatility of this week maybe and the event that I had early on mid of this week sort of consumed my time, or else I should have put it out. And of course, we started the mentorship program batch and a new batch and we had that on Sunday, the first session. So sort of that took up all my time, but I'm trying to push myself to possibly complete it and have it out at or before this weekend. So that should be out with a much more detailed analysis of this situation that I'm talking about. But generally looking at it, like I said, there's strength in the market. Today also the breadth was almost flat, 1800 stocks up, 1700 stocks down, and key sectors actually holding out between yesterday and today, which were, like I said, some of the strong ones are actually energy, metals and PSU. One of the outliers, which I also spoke about yesterday, and I've been hearing this a lot and I'm getting more and more conviction, is actually going to be banking itself. So people have sort of given up on the banking sector. The reason for that is that 2021 was a long consolidation phase during which, broadly speaking, they underperformed, even though they did move up in between. Once you got the sell-off in October and December, on a one-year basis, they would have been flat to negative. But I think that phase is over. And what you are now starting is much more impulsive. So when the rally in banks started in April and May of last year, actually it didn't look impulsive and we were questioning that move since then. And now what we see is a very, very impulsive rally from the bottom that we've made in December. Very clear 5 waves up. The pullback is only a 23% retracement of that first rally. So actually the retracement in Bank Nifty is much smaller than what we got in the Nifty itself. So it actually shows strength towards Bank Nifty having come back. And I don't think that's just a temporary event. I think it's something you're going to see in all of 2022. So much to people's surprise, those who've given up on banking is probably going to be one of the outperforming sectors of the year as, demand picks up, or at least the capex cycle kicks in again, something that a lot of people are fundamentally anticipating. And once that happens, it clearly leads to more credit growth for the banking sector. That's just one of the triggers. There could be definitely others, whether it comes from interest rate spreads widening and so on. Those could be other reasons why that could kick in as bond yields move up a bit. And the whole fear trade around bond yields might not be such a big one. I mean, I think maybe the market's discounting in advance the events that are likely to happen over the next year, because they've already been announced and they've been very well telecast or transmitted through word of mouth, which is another form of monetary policy. For those who have been students of economics, they know that monetary policy is not just about actually moving something, but it's also often conducted by the language used by central banks. And so that's, I think, the impact you're seeing right now. All the language that has been used has caused at least world markets, specifically the US market, to go into some kind of a correction on the fear of rising yields. But once I think the markets have sort of absorbed that, they will start playing out on the broader theme of inflation plus growth, which is still not completely gone away. You might get a slowdown in the rate of growth, but I don't think growth is completely gone away as yet. And so that will continue to be one of the drivers of the market. In fact, what could change is that if the US market is going to grow much more slowly, and since it's already moved up a lot, it could actually underperform the rest of the other developed markets like Europe or the emerging market space. And I think those are the trends to really watch out for in 2022. So I think this is what is really going on. This week's corrections just got to do with expiration, because the options, especially the stock options, hit their physical delivery based settlement next week. And so usually many times in this week you end up getting a correction because of that. It creates a shakeout, and then everybody who's in the options market has to lock into those trades as margins start going up from Friday into next week. It causes a unwinding for people who don't really want to hold on or pay those margins. Once that is done, I think the clear trend only emerges from tomorrow or from Monday, and sometimes even after expiry. So we'll see whether we see the clarity develop. But I do think we are very, very oversold. So we might start a bounce, whether it gains momentum immediately or it's slow and steady as we head into the budget. The setup is very, very interesting because last year also the market had actually sold off for 4 to 5 days ahead of the budget. But of course, that time it did right before the budget, and so it bottomed out just a day before the budget announcements, and then reversed very, very sharply from there. But it had a very, very similar oversold reading on hourly charts like the one we have today. And so that's why it's interesting to me that you have a similar setup, except that it's happening several days ahead of the event itself. So last time we topped out on the 20th of January. Today we are already at the low point on the 20th of January. So what does it mean? Because last time we actually bottomed a day before the budget, and then we rallied into February and then topped out there, and probably made a slightly higher high only in the Nifty in the first week of March. Whereas this time around, if we do bottom over here, which is the 20th of January, does it mean we are going to rally into the budget and then hit a wall? Or this time the budget has actually got some kind of positive surprises? But then again, that was also the case last year. So whether the correction happens one day before or happens 1 week before the event, that might be less relevant than what the structure of the market really is. And I think the structure so far is for a move higher. And that sort of means what I've been thinking is that this year's budget is also going to be quite positive in terms of its outcome. There's good reason to believe that because they have space to make it positive. The government has good tax windfall. They have room to spend on all the right places, whether it's to boost up the rural economy or whether it's really to create that infrastructure spend pace to really continue and keep the capex cycle going into next year. So they have room to do all of that. And they most probably should. If they don't, it would be a negative surprise. But having said that, the way things have gone over the last year has created room for them to continue doing what they've done and keep the economic momentum going. And why would they really back off from that when it's one of the things that will get them brownie points in the years ahead? So that's my overall take. We are fairly well set up for a continued move to the upside in the weeks ahead. There's no doubt, no change. Even though we've seen a 3-day correction and world markets have been a little shaky through the week, but I've given enough evidence of how these intermarket relationships go on. So you should see those posts, how both the dollar and bond yields behave, or how the US and Indian markets have been behaving over the last 12 months with some kind of an inversion. And unless the US really goes through a massive turmoil where they break weekly ranges and lose 20% or something, that would be very, very different. Unless something like that happens, the inversion really points towards phases where, we are sort of slightly disconnected from what is happening in the US. And like I said earlier, the bigger trend to watch out for would be the reemergence of outperformance of emerging markets relative to the US market. And that's a trend to really keep a very, very close eye on. So that's all from me for today, and wish you all a great week ahead. Thank you.
Nothing in this podcast is investment advice. Views on financial markets are in good faith to expand your understanding of how markets work. Please consult a registered financial advisor for the same.
And yes, please share this podcast with everyone you think can benefit from this knowledge.